Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host Jill Malandrino, global markets reporter at Nasdaq. We've been coming to you live from the Nasdaq PHLX options trading floor for quadruple witching expiration Friday. Joining me for this segment, we have Steve Blumenthal. He's the CEO of CMG Wealth Management Group, and we're going to focus on what's natural about business cycles. Thank you so much. Great to see you.
Great
as
to see
always.
you again.
We're in the late part of the cycle. Business cycles are normal. This isn't an outlier for the most part.
No, so we are at the end of this month, 115 months into this business expansion cycle. All these cycles end with recession. Where we sit with this current one is the longest is 120 months. The longest we've had in history, 1991 to 2001, great bull market that ended with the tech bubble. So that was the longest. The average is roughly 40 months. After 2001's recession to the next recession in '08, that lasted about 80 months. So we're 115, the longest is 120, we're second longest in history.
Is this because of the support that we've had from global central banks?
Oh, I totally think so.
Right.
Yes, yes.
And that policy is shifting. I mean, it certainly is in the U.S., and you're going to start to see other global banks follow suit as well. Do you think a lot of the reaction that we've seen over the past quarter is attributed to that?
Oh, I totally agree with that. The Fed put is gone, so you had it under Greenspan, Bernanke, and Yellen. And now under Powell, Powell's saying, let's see if this thing stands on its own.
We were surprised by the reaction on Wednesday. They took it up another 25 bips. They actually were a little bit more dovish in their statement. This was articulated. They've been very transparent.
Well, I think he either purposely delivered a message at the post-meeting conference, or he botched it. So it's one of those two things. But the clear message was we may see a couple more rate hikes next year. I don't think participants received what they were hoping to receive, a more dovish position, and the market reacted to that.
Right, but I mean, the Fed's mandate is to be married to the economy, not necessarily stock market action. That would be the case, or do you think they're taking that into consideration a little bit more?
Oh, so I think this is great, right? I think that it should stand on its own, but it hasn't for the last three Fed chairs. We've gone through a very unique period of time. We've had global central banks print $16 trillion in assets, and now all of them are pulling back. Not just the Fed, but all of them are pulling back. We're ahead of the curve compared to the other central banks, and the question is, how do we stand on our own two feet? How well?
Liquidity is an issue as well.
Liquidity is a gigantic issue.
And I think that's what the concern is, and that's kind of what we're seeing right here. But my next question is, what if you don't have time to go through a prolonged bull market? What if you don't have the luxury of dollar cost averaging like a younger investor might have? How are you advising clients with something like that?
Well, that's a great question, and I get asked this a lot. Dealing with investors for so many years, I know that behaviorally many behave badly. So they sell at the wrong time, they buy at the wrong time. So what my biggest concern is 75% of the money by next year is in the hands of pre-retirees and retirees. 75% of all the self-directed money in the hands of the people that can't afford to lose it. So if my daughter, who's 25, dollar cost average, boy, there's the next recession is going to be an epic buying opportunity. So that's good. But if you are 60 years old, I'm 57, and it takes, like it took from 2000 to present, roughly 12 years to recover from the first one, and the second one, minus 50, those last two recessions, each got us minus 50. It's that time to recover that you can't afford to lose. So I'm
in that situation too. You know, my parents are in their 70s. I'm clearly, I'm in the 40-year range at this point. For me, it's painful looking at the 401k statements, but in the same token, I'm like, this is a really good opportunity. When are we going to get this again?
Keep doing it. Just keep doing it, keep adding to it, and that's a great rebalance and add to the strategy. That's a great strategy if you have the length of time to work through the cycle.
So for people who are towards the latter part of this cycle, is cash good? I mean, that is a position.
Oh, cash is great. Yeah. I think cash is great, and the cash has been appropriate. This year, it's the single best performing asset class of all the asset classes, but of course, most people aren't in that. We're late cycle, we're 115 months, we have recessions, the average decline in recession is minus 37%, our economy looks good, I don't see recession in the next 6 months, but we need to watch it. If we lose 37%, if you lose 20%, it takes 25% to get back to even. If you lose 50, like happened in the last two recessions, you need a 100% return to get back to even, and that's where age appropriate and how you're positioning and how you're protecting what you're doing matters.
Do you think the recession we could potentially be going into feels like what we went through in the financial crisis of 2008, 2009?
I personally believe that the next recession is going to be tougher than the last two.
Really?
Different circumstances, but tougher. We've tripled up on the debt.
Right.
Investors with zero interest rate policy chased into leveraged loan funds, high yield funds, higher risk bond funds in search for yield. All of that liquidity enabled many, many companies to borrow. A lot of companies are borrowing that are surviving on the loan, on that debt that they're issuing. We've tripled the size of the debt. The next recession will wipe out a lot of companies, and I think that the opportunity on the other side is going to be epic. It's going to be great, but that's the risk.
All right. Well, thank you so much
Okay,
for joining
thanks
us
for
at
having
PHLX.
me.
And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.